The following BLTV program is brought to you by O'Flaherty Law. Please enjoy.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. This information is not intended as authoritative guidance or tax or legal advice. To determine which investment may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Prairie Sky Financial, a registered investment advisor and separate entity from LPL Financial.
Hey everybody, welcome to the Seize Your Business podcast. My name is Bryan McDonald of OnPurpose Growth, and today we have Elliot Vaughn of Prairie Sky Financial Group. And today we're going to be talking about an effective decision-making process when choosing the appropriate 401k or appropriate retirement for small business owners in a small business. So, Elliot, thanks for coming on. I appreciate it, man.
Brian, it's a pleasure to be
here.
here.
Pleasure to have you on. So, when it comes to choosing a plan for the business owner or the business, what are some of the things, the factors you have to take into consideration when choosing the plan?
Well, it comes down to suitability. In order to become suitable, you have to take in 6 key considerations. At least that's the way I see it.
Yep.
The first one is eligibility. Now, when you're a business owner, you have to understand that there are going to be members of your employees that have to be eligible for this plan. Mm-hmm. If you try to exclude certain employees, you can get in a lot of trouble. Okay. So the IRS, ERISA, the Department of Labor, they have set guidelines and tests to make sure that you stay compliant within the eligibility. The next part is compensation. Now, there's different forms of compensation. There's regular payroll, there's 1099, there's end-of-the-year bonuses, fringe benefits. So all these need to be taken in consideration when picking a retirement plan.
Okay.
And the next piece is contributions. Kind of going along with the eligibility, the contributions can't just flow to the executives or the tops of the companies. They have to flow properly and accordingly to all employees that are active in the plan. The next piece is vesting. So vesting, the way I explain it to my clients is, you think about when an employer contributes to an employee's account.
Okay. That's
not automatically, in some cases, the employee's asset. Vesting says after this amount of time, that becomes the employee's assets, where it's 100% theirs.
Got it.
Then there's distributions, and that's when you want the assets coming from the plan to the participant. How do you want that tax, and what kind of tax preferential treatment is accordingly taken in that plan?
Okay.
And then the last piece is loans, and that's just kind of a straightforward question: is do you want to allow loans or not? So those are 6 considerations that I like to make when advising on what kind of retirement plan employers take and want to implement into their business.
So when we're taking these, so we got these 6 factors that we have to think about. So what types of plans do we have to are available that we take these factors and use that as a kind of a decision-making process in?
Well, there are a lot of retirement plans out there, both qualified and non-qualified.
Okay.
But for small business owners, I think that there are 6 primary plans that you need to take in consideration. Yeah. The first one is called the MyRA, which is a federal plan that invests in government bonds. The next one is the SEP, or the Simplified Employee Pension Plan. The next 2 are both kind of the same, but they have a different, call it a different flavor. And those are simple IRAs and simple 401ks.
Okay.
The last 2, one is the one participant or solo 401k, and then there's also a defined benefit pension plan. Pensions have not been very prevalent in the last 10 to 15 years, but I'm sure that a lot of people's parents they were involved with pension plans a long time ago, so they're still around today.
So what is at a high level? What are slight differences between these? Because it seems like there's some that are similar and some that aren't. Or
there's a lot of different flavors. So when you think about a 401k plan and an IRA, IRAs typically they have lower contributions, so you can't contribute as much as say you would be able to a 401k. So for example, You might be able to contribute, if you're under the age of 50, $18,000 to a 401k, but an IRA, if you're under the age of 50, that number is $5,500 or $5,500
per employee or
participant.
Sorry. Okay.
So there, and there's just a lot of, again, the rules and the guidelines and the tax treatment, they all get very convoluted and difficult. So that's why it's important to talk to your tax professional and to your financial advisor about these different plans.
Okay, so if I'm a small business owner and I don't have a lot of employees, right? Maybe I'm a dentist or a doctor, maybe I have 1 or 2 employees, maybe I'm a consultant, we don't have any employees. What do I have to think about? Maybe if I had can I use a 401k? Is there some other way of thinking about it? What do I have to be thinking about?
Well, if you're a small business owner and you're a one-man team, just yourself, the first question I would ask you is, do you intend to be hiring anyone in the near future? Because having more participants or employees means that it might have higher administrative costs, and you might have to make contributions if you already have a 401k plan or another retirement plan set up already. So that's one consideration I'd be making. The next consideration I'd be making is, do you want to allow those employees to make salary deferrals? And what I mean by that is, you might be able to just have the employer contribute to their accounts on the employer's volition. Do you want to allow that employee to make contributions for themselves within that plan? So that's another
kind of
consideration.
outside of the regular contributions. Would that be? Or
yeah, there might be a match involved.
Oh,
or,
got it.
With 401ks, you might be able to put money in, or you might be able to stop it if you want to. So it depends on what the employer is trying to accomplish with that retirement plan. And then the last consideration I'd be making is, what's a higher priority for that employer? Do you want to try and keep administrative costs down, or are you trying to put away as much money as you can as the employer or as the owner? Mm-hmm. So what is more of a higher priority for you? So those are a couple things that I consider if you're a small business owner that doesn't have any employees at this time, or only a few, like you had.
Yeah, because once you get past a few employees, then the rules kind of change, if you will.
The considerations they begin. There's a lot more administrative costs potentially to it, and I'll kind of relay back to my first 6 considerations.
Got it.
Meaning that you have a lot more to try and take in. You're not just thinking a little bit more of yourself. You're thinking about, the X amount of people that you have under your employment.
Got it. So what if you're a small business owner and you already have a 401k in play? Is that once you make a decision down one road, that's the only road you can go?
No. What has become a little bit more under the limelight lately is what's called a non-qualified deferred compensation plan.
Okay.
Now, a non-qualified deferred compensation plan allows employers to kind of they're allowed to put more money into, not put more money, but they're allowed to defer a lot more of their income, or a portion of their income, whether it be, again, payroll, 1099, mm-hmm. or bonuses, that kind of thing, and defer it.
Okay.
And now, one thing that I will say, it's kind of a con of this plan, is that, we're weighing pros and cons, is with a 401k, your assets are segregated. So the 401k and the plan assets of the 401k, they're not contributed or have anything to do with the general assets of the company. But that's not necessarily the case with a non-qualified deferred compensation plan.
Got it.
And the reason why that is important to consider is because if your assets are commingled with the general accounts of the company, then that means if the company goes under, all of a sudden your retirement plan becomes subject to creditors of that company.
Oh, got it. Okay.
So in this way, it allows owners and executives to defer a larger portion of their income later on down the road, but it does have risks to it as well.
Yeah. So you're deferring income, you're not saving, you're not actualizing and saving it per se.
You're deferring it. Yes,
You're deferring it. Okay. Yeah, it sounds like a very challenging world to live in. So
there's a lot of moving pieces to all of this.
It sounds like it. So so now do we need to go any more in depth on those non-qualified plans, or is that kind of just as much as you want to share? I know there's probably a ton to go into. I just want to make sure that we covered everything in that area.
Yeah, I mean, there's all these different forms of compensation that you need to be taking consideration with a non-qualified deferred compensation plan. But there are considerations that need to be made if you do want to implement a non-qualified deferred compensation plan.
Got it. So it's once you've made the decision, once you've walked through the decision of am I going to have one of these plans or not, then the next step is, okay, now how do I actually implement this with the different ways of taking that deferred compensation, it sounds like.
Yes.
So that's just deciding the fork in the road is just the first step. Once you decide which way, there's a lot of other decisions that have to be made.
Exactly.
Okay, perfect. So like we said, this is very complicated, convoluted, however you want to say it. How, as a CFP, are you able to help organizations, business owners get through this compared to somebody else who's not?
Well, I think it comes down to experience and education. Kind of relating back to the non-qualified deferred compensation plan, there are things that we need to take in consideration. One of those being, obviously, is are you maximizing your contributions within the 401k? The next part is, will this company continue to be successful down the road and while you're receiving the distributions? The next one, obviously, is how will this affect my future tax bracket when I'm receiving those payments? What investments are within that non-qualified deferred compensation plan? And lastly is, can I afford to defer some of my income right now? Now, with most, with financial advisors, there's financial advisors in all walks of life. What comes down to is the education, the experience. I am a CFP, and within the CFP board, they have instilled education to make sure that you understand, the certain retirement plans and the non-qualified deferred compensation. We get tested on that. That's why, I'm able to understand this. And those that have gone on to get their master's degrees in personal finance, or have been in the business for a very long time and have been able to, learn all these different traits and all the different retirement plans that are out there, and try and keep up with the ever-changing tapestry that is, qualified retirement plans and non-qualified retirement plans, amongst everything else. That's really when you begin to become a benefit to those that are seeking the advice, and those that are trying to, help not only themselves but also their employees within their company.
Right, and it sounds like this isn't a decision that somebody makes solely. A small business owner doesn't make this decision solely with you. They're working alongside their tax advisor, and you're working together as a team to get this done.
Exactly.
Yeah, they're not. If they're just working with the financial advisor, when I say they, I mean a small business owner, you're going to miss the boat by not pulling in the other pieces.
Exactly.
And it sounds like you help put that together, whether if it's an existing relationship or a new relationship that they need to make sure that this gets done.
Well, I like to think of myself as I'm a big Chicago Bears fan, so I like to think of myself as Mitch Trubisky.
Okay.
If Mitch Trubisky was out there and just marched out on a Sunday afternoon against the Packers, he'd probably get his brains beat in. But considering that he's got his linemen, he's got his the defense and the wide receivers and the running backs and the coaches and all that stuff, they form a dynamic team. In the same essence, a company is a team. So you have to try and bring in all the different resources you can, and that's kind of where I try and bring in my value is, okay, I think that we have a good strategy here, but we also need this specialist here, and we need this, I think we need to bring in all these different pieces, and all of a sudden we've got a great strategy to lead to success, and we have a good game plan that, knock on wood, hopefully will lead them to, continued success or making a good amount of money or an impact on the world, and for the Chicago Bears, a Super Bowl.
Yeah, right, exactly. So I will end with this question just to help crystallize in people's minds. So as they're thinking about, if they're going to go down the defined benefit plan or some of these more complicated plan routes, what are the general pieces of pie they need to have together? Is it an advisor, a tax person? Is there an attorney? What's just a general idea, like have these players on your team? They may not have them now, but help them understand kind of who they have to involve.
Yeah, a financial planner, a financial advisor is a good place to start. I imagine most people, come April 15th, that day is a day of infamy, so they usually, some people may do it on their own, but most everyone knows a tax professional, a CPA of sorts. So, those are two very good pieces to have. An attorney is always beneficial to know, a good attorney, whether it be to draft up trust documents or, with most businesses, they have to become incorporated. So, I imagine that most of those attorneys are probably just one phone call away to assist with, retirement plan documents or non-qualified retirement plan documents if need be. Okay. So those are probably three major key components that I'd want to have when implementing this. But I think that there might become a need for someone else, whether it be an actuary or a TPA. So
based on how complicated, the more complicated you get, the more players you have to have
exactly
in the team. Okay,
exactly.
Perfect. Well, I appreciate your time. I appreciate you being on, and thanks everybody for joining us for this episode of Seize Your Business Podcast. And if you would like to get a hold of Elliot, his information is going to be shared across this video and anywhere that this video is posted. So please reach out to him and have him help you with any of your retirement needs. Thanks. Take care.
Thanks so much for watching our video. If you have any questions, feel free to comment below. Click the subscribe button for new videos every week, and download and review us on iTunes. Visit learn-about-law.com for other legal-related articles and videos. Visit our business podcast and video blog, seizeyourbusiness.com, and visit Making Real Estate Fun for real estate videos and podcasts. Call us at 630-324-6666 for a free consultation.